Morning, friends. Happy Thursday. Welcome. Struggle was real this morning. Like nothing was cooperating. You're used to me being a minute, 2 minutes late, but this was like StreamYard was working and then it just froze and then my whole computer was not cooperating. So good times, right? Good times. So let's make sure, as always, I'm just make sure things are working. And if you're watching live, let me know where you're watching from. Say hey. If you're watching on replay, let us know too where you're at. I always like to know who's watching, who's joining, and where you guys are from. This doesn't say we're on Facebook. If you happen to be on Facebook, hi, Reed or Virgie. Yes, hi, Arizona. Oh, I'm jealous of your weather, man. Like, it's chilly here. It's sunny, so I'm not sad about that. It's sunny today, but it was like 30. There we go. It was like 31 degrees when I went on my walk this morning. So, but as long as the sun is shining, I am good. All right. So let me pull up. Okay. So you guys, we're in the middle of what I'm calling the business structure series. So for those of you just joining us, let's start. For those of you just joining us, maybe you're here for the first time, you're wondering who is this person I'm actually listening to. Hi, I'm Brie Beers. I am, excuse me, I am choking. Better. Brie Beers. I own Brie Beers and Associates. We are a Denver-based accounting firm. We work with clients across the across the country. I myself am a CPA, a certified tax coach, an advanced tax strategist, a fractional CFO. All these things, these titles that say that I passed tests and I took courses. I have 20 years of experience in accounting, and that's really, that experience is where I've learned what I am passing on to you guys. I am in my 12th tax season, so tax is my jam when it comes to accounting. That's where I've spent most of my time. And then the other thing is, in the last 7 years, I've been a business owner. So whereas lots of big accounting firms, you're dealing with accountants who know tax, who know the accounting world, I also know the entrepreneurial world. So I'm able to make that connection that some, only accountants who are also firm owners can do for you. And over the last probably 6 or 7 years, around the same time I bought my firm, I really started digging into tax strategy and learning how the tax code can be beneficial to not just the rich and the wealthy, right? To everybody. Because I think there's this, not stigma, but there's just this belief that the tax code is written for the rich and wealthy. And while the rich and wealthy are the ones that are taking the most advantage of it, there is nothing limiting all of us from utilizing these strategies and these loopholes to save on taxes. And so I've kind of made it my mission or my goal to help the middle class build wealth by saving money on taxes first. I feel like tax strategy and tax planning is the first step to being able to build wealth, because it's kind of like giving yourself a raise without actually making more money, right? If you make the exact same amount of money this year as last year, but we implement some tax strategies, you could have thousands of dollars extra in your pocket to put back into your business, put into your retirement, into your kids' college, whatever that looks like to you. So that's my thing. Okay. So right now, you guys, today we're talking about partnerships and C corporations. And I know there's not a ton of you out there that have these types of structures. But so I do want to talk first about what this series we're in between looks like, or we're in the middle of looks like. All right. So excuse me, that is not the right page. I have my notes in front of me and I'm looking at, I don't even know what. So we're talking about the taxation of the different business structures. Last week, we talked to the sole proprietors and single member LLCs. So those of you that report your income on Schedule C, okay, of your individual return. Today, I'm going to be talking to my partnerships and my C Corps. Next week is what I know everyone is looking forward to. So hang in there, and that is S Corps. Not next week. Next week's Thanksgiving. The next training we do is going to be about S Corps. There we go. And so before we can jump into the taxation, how we can utilize it, it's important to kind of understand the differences between these different taxing structures. And also, the fact that your legal structure is different than your tax structure. Okay, so when you set up your business, your legal structure can be a plethora of things. Okay, if you are going into business by yourself, right? You just start a side hustle. You start doing work. If you're collecting money under your social security number, you're a sole proprietor. If you set up an LLC and it's just you default to the single member LLC. As soon as you decide to go into business with one or more other people, all right, that your business legal structure is going to be a partnership. And there's tons of things within partnerships, right? You can be a PLLC, a PP, an LLP. There's different letters you can put at the end of that partnership that legally structure it differently. But from tax point of view, a partnership is a partnership. All those kinds of partnerships fall in the same bucket. All right. And then if you would create a business structure, right, a business entity, and you create a corporation, you put those words INC at the end of your business, then you default to a C corporation. Okay. And so business structures can be, there's at least, I'm thinking off the top of my head, at least 8 different ways to structure your business from a legal perspective. Okay. But there are only 4 ways to tax your businesses. Okay. Last week, we talked to those of you that fall into these Schedule C businesses. All right. Sole proprietor, single member LLCs. Next week, we'll talk about making that S Corp election, which is just a tax election that, so you can be taxed as an S Corp. Today, it's going to be short and sweet because I'm talking about partnerships and C Corps. And there aren't a ton of you. I know there's not a ton in our client base. And I know based on the conversations I've had with the people in our Facebook group and the conversations I've had with people that follow our business page, there's not a ton of you in here, but there are some of you. So I did want to make sure that I came in and talked to you guys and made sure you understood how the taxation of your business worked. All right. So we're going to start with my partnerships. All right. So if you are in a partnership, if you started a business with 1 or more people and you did not elect to be a corporation, okay, that's something you did when you structured your business. If you created an LLC, an LLP, anything except for an Inc., a corporation, then you are a partnership if there are 2 or more of you. All right. So with a partnership, you are going to file a Form 1065. That's the tax return that you file to report all of your business activity. All right. And then with a partnership, every partner then gets a K-1. So the partnership itself does not pay tax. So when you file the 1065, that tax return, there's never money due with that Form 1065. There's never money due from the partnership. Okay. What the partnership tax return is, that 1065, it's a reporting document. It reports all of your business income, and then it allocates it via the K-1 to each of the partners to say, this is how much money you have to report as income that you received from this partnership. All right. And there are 2 ways that you can receive money, taxable income from a partnership. The first is through your guarantee payments. All right. When you set up a partnership, a lot of times you'll be working in the business as well, like doing things right in the business, as well as having your equity, your ownership in the partnership. Okay. And the payout from those 2 are 2 separate buckets. So in a partnership, your guaranteed payments are what you're getting paid for the work you're doing in the business. It's kind of like being on payroll, right? You're not on payroll. That's not allowed. Partnerships don't do payroll for their partners. But you get those guaranteed payments, and that's reported on your K-1 in a box. And those are the payments that you're going to get no matter how that amount is guaranteed to you, no matter how good or bad the business does. Okay, so think of it like a payroll, right? Think of it as compensation for the work you're doing in the business, in the partnership. Okay, and then whatever income is left, okay, so all of your businesses, all the partnerships, revenue minus all the expenses and the guaranteed payments, whatever amount is left, let's say it's $100,000, that amount is allocated to each partner based on their ownership percentage. So if it's you and another person and you're 50-50 owners, then each of you is going to have to report $50,000 in taxable income on your personal return. And the way you're able to do this is simply through that K-1. Okay, so your 1065 does all the reporting. and then issues you a K-1, and you give that K-1 to your tax preparer, or you enter it into TurboTax, I really, really, really advise against anyone who has a business of self doing your tax returns. Yes, I'm not saying you're not competent. Everyone can do it. It's pretty easy. But if you hire a good accountant, whether it's us, whether it's someone else, if you hire a good accountant to help you prepare, they're going to help you save money. Even without tax planning and tax strategy, you guys, just a competent accountant is going to help catch things that maybe you're missing, or look at ways to report things that are more tax advantageous to you. Okay. So when I tell you guys to get a tax preparer, I'm not saying it because I don't think you can do it yourself. I'm saying it because it's really hard to do it right by yourself, and make sure you're catching everything you can in terms of deductions. All right, off my soapbox. So partnerships. So when you're a partner in a partnership, you are responsible for paying your portion of tax on the income from the partnership. And one thing I get from partners, because we have partnerships that are our clients, is we'll have a partnership that has two partners, and one partner will be like, why was my tax higher than John's tax? We're 50-50 partners. But you got to remember that the K-1 is just one part of your whole tax picture, right? And each individual has a different tax picture. Okay, so in this case, if one partner, if their only income comes from the partnership, and so their only income for that year is that 50 grand from the partnership, versus John, who has the K-1 partnership, but maybe he also has a W-2 job, maybe his wife has a W-2 job, they have higher income. There's moving pieces. There's different parts that are going to affect your in taxes. Okay, so that is, in a nutshell, the taxation of a partnership. All right. And when we talk about different ways to make sure you're saving on your taxes, there's a couple really simple things to make sure that you're taking advantage of. Okay. And the biggest ones is that through a partner, sorry, I have a hair on my face. When you're a partner in a partnership, all right, all of your expenses, including your home office and use of your vehicle for business use, those things are tax deductible to you. Okay. And you can do it in one of two ways. You can either run those expenses directly through the business. All right. So you can, allocate, you can turn in your receipts and your spreadsheets, whatever it is you have to show your home office expense, your business use of your vehicle. You can submit those to your business and have your business reimburse you for those expenses. Or you can report them as unreimbursed partner expenses on your personal return. Most of our clients tend to do it this way because you want to make sure that you're getting the benefit of the money you're spending. Okay, so let me give you an example of this. Two partners, right? They're 50-50 partners, John and Bob. It's always John and Bob. Okay, John spends, he does his home office deduction. He drives a ton. Maybe he's the salesperson that's driving around doing things, right? And so at the end of the year, his expense report is $10,000. All right. Then you have, I can't remember was that John or Bob? Person one. I already screwed up, you guys. So they have $10,000 in unreimbursable expenses. Person two, let's say they don't drive around. They have a smaller home office. Your choice, right? Let's say they have $5,000 in unreimbursable expenses. If we're running reimbursable expenses through the partnership, that means both partners are submitting their claims to the business and the business is paying it out. Okay. They're reimbursing them, but then it's taking the full business income down, and that gets split 50-50. Okay, so the benefit, even though this person spent $10,000, this person spent $5,000, the benefit when it comes to the taxable tax deductibility of those to the business is split 50-50. So most partners, unless it is very even or pretty comparable, most partners that we work with, they do unreimbursed expenses. And what that does is you don't run it through the partnership. Okay, you still keep your records as a partner. Okay, you keep your records of your home office, your and your business miles driven, but then you do not submit it to the business. The business gives you your K-1, And then within your personal return, you're allowed to claim those unreimbursable expenses against your partnership income on your individual level. Okay. So that's the biggest thing we see in terms of like, how can we just make a little tweak to help our partnership, just the tax deductibility help us, right? The other thing we see is, and this is not a tax strategy, this is just a no-no, all right? When you are a partner in a partnership, you should not be on payroll, okay? It's a IRS rule that says you don't run payroll for yourself, okay? You pay yourself through guaranteed payments, all right? In the end, I've done it. In the end, it washes out when it comes to like what the government gets, all this stuff, but that's how they say you have to do it. Okay. So you may have a partnership that has employees, and that's fine, but partners of a partnership cannot be employees within the partnership. Okay. And that's very different than when you're taxed as an S Corp or a C Corp. Okay. And we'll talk about C Corps in just a sec. Okay. And so partnerships, when it comes to the taxation of partnerships, okay, very similar to when you're a sole proprietor or a single member LLC, in that it flows through to your personal return. You're going to pay income tax based on whatever your marginal tax rate is, okay, because the business does not pay the tax. You pay the tax on your portion of income from the business. Just like when you're a sole prop, you pay it, it flows through as ordinary income, okay? And then, I'll get to that question, yes. And then, where was I? Not only are you subject to income tax, you guys, but you're also subject to self-employment tax, okay? So going back to the Schedule C, right? My sole props, when you're just one person, if you make $100,000 on your Schedule C, you're going to pay your tax bracket, 22%, right? Then you're going to pay an additional 15.3% in self-employment tax, okay? Not to mention your state tax. Partnerships are the same way. Both your income from the partnership that flows through on line 1 of your K1, okay, so your share of profits, plus your guaranteed payments, right? The money you receive from the partnership for working in the partnership, your compensation for work, are subject to self-employment tax. Okay, so you are going to be assessed 15.3% self-employment tax on those numbers, on that income, on top of your income tax. All right. And this is because when you're an employee, right, you pay payroll tax. You pay half of it, your employer pays half of it. All right. When there's no W-2, there's no employer taxes, right? There's no payroll taxes, excuse me. So the offset for that is self-employment tax. All right. So one way or another, you're paying this extra 15.3%. All right. It's just a matter of how. And that depends on how your tax or how your business is structured from a tax perspective. All right. And so with partnerships, you do get to a certain level or threshold where it may be beneficial to become an S Corp. We'll talk about that next week. When you are a sole member, right, it's pretty cut and dry when you want to make an S Corp election. And we'll, again, talk about that next week. But when you're a partnership, it's a little different because partnerships provide a little bit more flexibility than when you've made the S Corp election. All right. And we will talk in depth about that in our S Corp class or session. All right. And the question says it has to be in the agreement, correct? And I think you're talking about the guaranteed payments or the profit split or the everything. Yes. So in a partnership, you guys, let me back that up. Hashtag not an attorney, but anytime you're setting up a legal entity, whether it's just you setting up an LLC or you are setting up a partnership with someone else, or you are creating a corporation, there should always be articles, or an operations agreement or a partnership agreement, some legal paperwork that says who gets what, essentially. All right. So when it comes to a partnership, that operation agreement is going to say profits are split this way, equity is split this way, losses are split this way. That's one of the differences between a partnership and when you make that S Corp election, it's straight down the middle. Like if you're 50-50 partners, everything is 50-50. With partnerships, you can be a little more lenient. You can say, I get 50% of profits, even though I'm only a 30% equity owner. Like there's different, you can really kind of mess around with it a lot. People tend not to, at least not in our sized businesses, it's pretty still cut and dry. But so a partnership agreement or operation agreement is going to outline that piece. It's also going to say who gets guaranteed payments and what those guaranteed payments are for. All right. And a lot of times your guaranteed payments are an addendum because it can change each year. That can change depending on how your duties in the business change. All right. So that's partnerships. Please feel free, you guys, to ask any questions because I'm happy to answer anything that I'm not touching on. Just because I didn't think about it, that's fine. But partnerships, again, there is an opportunity for partnerships to benefit from making an S Corp tax election that we'll talk about next time. So now C Corps. C Corps are cut and dry, you guys, super cut and dry. Because whereas every other type of tax structure flows through to the owners, where the owner pays the tax ultimately, C Corps are a whole separate entity, a whole separate being. All right, they're separate. Okay, so sole props, single member LLCs, right? Your income is reported directly on Schedule C of your personal return. All right, partnerships and S Corps that we'll talk about next time, they are a separate return that reports all the income, reports all the expenses, then provides a K-1 to each owner or partner to report their portion of taxable income to report onto their personal return, right? So it's called a flow-through entity. Okay, the business does not pay tax with the tax return. It just reports it so that you can report or you can pay it on your personal return. Okay, so all three of those tax entities, the individual is responsible for paying the tax, and they pay the tax based on their marginal tax rates. All right, C Corps, different story, different monsters, completely separate. So there is no flow through. Okay, a C corporation is a business and they have revenue, they have all their expenses, and then whatever's left, that is their profit, that's their taxable income. They pay 21% flat tax rate right now. All right, seems super simple, right? You're like, well, why wouldn't? Very few of us are in a 21% tax rate. 22% is the most common tax rate for working Americans. All right, and that tax, it goes up 22, 24, I think 27, 32, 37. Okay, so the question is like, why would everyone not just do a C Corp and pay 21%? And this is where you hear the term double taxation. All right, so this is because most of us that are small business owners, right, we are living off of our business income. A good chunk of what our business makes comes to us, right? Because we pay ourselves, we have to pay our living expenses, this, that, and the other, right? So with a C corporation, different business entity, 21%, you can be an employee within your C Corp. Okay, so let's imagine I have a C Corp, okay? I have a C corporation, I'm an employee within my business, and so I'm paying myself a salary that I'm living off of, okay? And that's all great and dandy, all right? But what happens if I want to take more than my reasonable compensation says I'm worth? Okay, we talk about reasonable compensation in both C Corps and S Corps, and for different reasons. For S Corps, it's always we have to prove that we have our compensation high enough. And we'll talk about why that is in the S Corp class. But with C Corps, with employees within C corporations who are also shareholders, okay, they tend to overinflate their wages because what they're trying to do, S corporations try to keep their wages low to prevent or to minimize their self-employment tax. Employees who are also shareholders in C Corps, they get it. They're paying that 15.3%. They're paying their payroll tax. What they're trying to avoid by inflating their wages from the C Corp is avoiding what we call double taxation. And that's on the money that they want to take out of the business above and beyond their wages. Okay. So double taxation goes like this. When you're a shareholder, so we decided we did a reasonable comp, 100 grand. Okay. I earn 100 grand a year for whatever it is I do in my C corporation business. That comes to me. Okay. When all is said and done, the C Corp made $1 million, spent, $700,000. So it has $300,000 left in profit. Okay, that is its taxable income. That is what it's getting taxed on. Okay, so 21% of $300,000. However, me as a shareholder, I'm going to get distributions from my C corporation, right? Because whether it's because I need more than my 100,000 to live, or because we're paying out distributions this year because that's what the C corporation is doing. What then happens is those distributions are not a taxable deduction to the business, but I'm going to receive a 1099B, a 1099, not a B, div that says I received $50,000 in dividends from this C corporation. And those are going to be taxed on my personal tax return. They are at a favorable capital gains tax rate if they're long-term, but you're still, the double taxation comes from the C corp paid 21% on those profits. And now I, on the individual level, am paying 15% on the dividend. Okay. So 37%. So unless we're in that highest tax bracket as the personal, on the personal level, that C corporation, if we need to take money out of the business, is not going to be tax beneficial to us. Okay. Most of the clients we have who are C corporations they are ones who want to have an off calendar year. A lot of construction companies who have maybe like an October, September year end, because summer is their big construction time. Some I think ski resorts tend to be a C corp, so they can have an off calendar year. That's one of the benefits of having a C corporation. So that their tax year can end when their busy season ends. All right. This is something, guys, when it comes to C corp or like deciding to be incorporated or not, that's something that starts at the legal level. All right. Because many times there are legal reasons why your attorney wants you to be a C corp. All right. But then the flip side to that is like, okay, then we got to talk to an accountant to figure out what are those tax implications, because it's a balancing act, right? As you want to make sure that, because with a C corporation as well, there's a lot more, I don't want to say hoops to jump through, but there's a lot more record keeping and reporting to handle. There are a lot more tax benefits when you're a C corp that you can utilize. With healthcare and health savings and stuff like that, and retirement, you have a little bit more flexibility. So it is a conversation that you don't want to have with just your accountant or just your attorney. It needs to be a team effort. All right. So that's partnerships and C corps. If you guys have any questions, definitely let me know. But what we're going to do, again, I keep saying next week is Thanksgiving. I'm not going to be here. The week after, we are going to talk about S corps. And this is one that is important because you get a lot of people. We get so many clients that are like, hey, my friend said I should elect an S corp to save taxes. And so that's what we're going to talk about. What does that exactly mean? Like, why and how are you saving money by electing an S corp, and who is it right for? And are there other benefits? All right. So that is that. I was trying to keep it to 30 minutes. I'm always trying to keep these to 20 to 30 minutes, you guys. So pat on my back, I did it. For the rest of the year, my schedule. So next week is Thanksgiving. The 5th, I'm out of town, but I will still have the training, whether I record it before I leave or I do it while I'm gone. But that's the one that's going to be on S corporations. All right. And then the following week, we're doing BOI. So the business ownership information reporting. Okay. Be here for that one. That is a super duper important one. Everybody who has a business needs to make sure they fill out this BOI by year end. All right. So make sure you join us for that. And then the 19th, we're going to do a Q&A. All right. That's the plan for the rest of the year. So come on and join me. If you guys are wanting to do some tax planning, I do get DMs like, how do we work with you? What do we do? We do not have to wait till tax season. You guys, if you're wanting to work with us on an accounting level, meet with us now. We can actually work. We offer free tax analysis. We'll do a free tax analysis, see what we can put into place to save you money in 2025. And we're running low on time, but we still have a few more weeks that if you get in, we can implement some of these strategies to save you a few bucks in 2024 as well. The link to schedule that discovery call is somewhere, up or down, depending on where you're watching this. So I thought you guys have a great weekend. For those of you that celebrate Thanksgiving, have a great Thanksgiving, and we will see you in a couple weeks. Bye.